Hello and welcome back to The Notes, coming to you again this week from our offices in New York. One of the big questions surrounding the US stock market at the moment is corporate profits. Margins are very high, they've been high for a long time. Are they sustainable? With me now to discuss this is the head of PI Economics in Connecticut, Tim Lee. Tim, thanks very much for joining me today.
Thank you.
Let's start by taking a look at this chart which you produced, which shows the share of profits in the economy, and it makes it look as though companies are doing abnormally well. What's going on here, do you think?
Yes, so the chart shows that at the moment, after-tax corporate profits are about 10% of GDP, which is the highest we've seen since the Second World War, at least, and the longer run average is just over 6%. So profits are well above, and historically, the profit share in GDP has tended to revert to the average.
So is it because capital is beating labour in a way that it historically has never done, or what lies behind such a high margin, in your opinion?
A lot of it is to do with leverage and the growth of debt, which has allowed the leveraging up of returns on assets. And that in turn is really being driven by central bank policies. Now,
you've produced a fascinating chart that tries to explain this all in one go. What we're looking at here, as I understand it, is the leverage that companies have, but it's been adjusted to see what that leverage would look like if their profit share was more in line with the historical norm. Take me through how you produced this chart and what it implies.
What I do is I say, well, what would the total outstanding market value of equity be if we assume that the market values off current profits and then profits revert to the mean? So I've adjusted the market value of equity by the diversion of profits from the mean profit share. And then I look at the outstanding value of corporate debt divided by that adjusted market value of equity. And I call that the adjusted leverage ratio.
Okay, now that suggests obviously that companies are alarmingly over leveraged. Plainly, we all know that rates are being held very low because the Fed is intervening. Can this situation continue as long as the Fed keeps intervening with QE? Is there a risk that this could that we could see a comeuppance for corporates, even while the Fed continues to impose stimulus?
We've only seen these sorts of levels in the past when inflation and growth has been high, and that is shown by the fact that when we've had these sorts of high leverage levels in the past, in the late 70s and early 80s, market interest rates were high. Now, QE is part of it, but really it's more the message from QE than the liquidity. The chart shows that we're a long way from a sustainable position. That can start to disintegrate and fall apart, I think, without central banks doing anything dramatic.
Great. Well, not great, very alarming piece of analysis, Tim, but thank you very much. I think the clear message from that is that people take heart from those earnings, but ultimately the earnings we're seeing are derived from an extremely optimistic view of the power of central banks.